Picture this. You've just finished your first big year working for yourself. You're proud, you're busy, and then your accountant sends you a number that makes your stomach drop. If you're earning around $90,000 and you've set nothing aside, you could owe over $23,000 in one single lump sum at your first return, with no employer withholding to soften it. And if nobody warned you about this, that's not your failure. The rules genuinely change the day you go out on your own, and nobody hands you a memo. Today I'll walk you through exactly how to sidestep that shock, and here's the part most people miss: how to stop quietly falling behind on your super at the same time. Here's why this catches you so off guard, and it's really not your fault. When you were an employee, your tax was drip-fed out of every single pay through PAYG withholding, so you barely noticed it leaving. Now that you're on your own, none of that happens automatically. According to the ATO's 2025 to 26 schedules, a sole trader on $90,000 faces around $20,000 in income tax, plus a 2% Medicare levy of $1,800 because nothing was withheld during the year. The whole bill, about $22,000, lands on your desk in one hit. Now, here's the good news. Once you see it coming, it's completely manageable. Your very first move is to open a dedicated tax account, completely separate from your everyday business account. From your very first invoice, automatically move 25 to 30% of every client payment straight into it, and then treat that money as if it doesn't exist. The ATO expects you to plan for tax across the year and not scramble for it in June, so this one simple habit means the cash is already sitting there, waiting, when your assessment arrives, instead of quietly disappearing into rent and groceries. Auto transfer beats willpower every time. Next, log into MyGov and open ATO online services under your sole trader account. Pull up last year's tax assessment so you can see your real effective tax rate on business income. Not a guess, the actual number. Then opt into PAYG installments if the ATO offers it to you. This spreads your tax across quarterly payments instead of that one brutal lump sum, and it also shields you from the general interest charge, which the ATO publishes each quarter, and which often runs around 8 to 10% a year on unpaid amounts. But hold on, because there's a second silent trap most new business owners never even see coming, and it's the one that costs the most over time. Here it is. From the 1st of July 2025, the super guarantee rate permanently rose to 12%. Meaning, if you were still an employee, your boss would have to pay 12% of your ordinary earnings into super by law, according to the ATO. But as a sole trader, you're completely excluded from that. Nobody's paying it for you. So unless you actively do something, you're missing the equivalent of a 12% pay rise into your own retirement every single year. And here's where it gets genuinely important, because the fix is easier than you'd think. Step 3 is simply to pay yourself super the same way an employer would. Calculate 12% of your expected income, so on $90,000, that's $10,800 a year, and set up a monthly pay or direct debit of around $900 into your existing super fund. Let me show you why this matters so much. The ATO confirms an employee on that same income gets $10,800 a year paid in for them. Over 30 years, even at a conservative 5% return, that could grow to roughly $720,000 by the time you're 65. That's not a small gap. That's a completely different retirement. Step 4 is the one people forget, and I want to be really honest with you, forgetting it is expensive. After you've contributed, you must submit your fund's notice of intent to claim a deduction for personal super contributions. And you have to do it before you lodge your tax return. If you skip this form, the ATO treats your money as a non-concessional contribution, and you lose both the tax deduction and the lower 15% contributions tax. Inside the fund, your contribution is taxed at just 15%, well below a middle earner's marginal rate of 32.5% or more. So this one bit of paperwork is doing a lot of heavy lifting. Let me show you exactly how much. Here's why the form is worth 2 minutes of your time. Say you contribute $10,000 and you lodge that notice. Your fund pays 15% contributions tax. That's $1,500, but your assessable income drops by the full $10,000, saving you roughly $3,350 in income tax at around a 32.5% to 34.5% rate, including Medicare. Net it out, and you're about $1,800 ahead immediately, before you even count all the future investment growth. Now, I should say the exact figure shifts depending on your income and marginal rate, so treat this as an illustration rather than a promise. But the direction is always the same. The deduction beats the fund tax. Your final step is to audit your caps so a good deed doesn't accidentally turn into a penalty. Jump into ATO online services, head to the super section, and confirm your concessional contributions stay at or under $30,000 and your non-concessional under $120,000 for the year. This matters because breaching either cap can attract tax of up to 47% on the excess, according to ATO rules, which wipes out nearly half your benefit. So before you make any large top-up, check your fund statements first. And here's the number most people never stop to think about: the real lifetime cost of doing nothing. Before we wrap, let me flag the mistakes that hurt you the most, because if you can dodge these three, you're already ahead of most people in your situation. The first is treating your business income like a salary and spending the tax portion, which leaves you exposed to that general interest charge of around 8 to 10% a year if you can't pay when the bill comes. The second is assuming super is optional until your business is bigger, when in reality skipping it for decades can leave you hundreds of thousands of dollars behind an employee on the exact same income, according to ATO and super figures for 21, 25 to 26. And the third, of course, is forgetting that notice of intent form we just talked about. Let me put the real stakes in front of you. Imagine you're a freelancer earning $90,000 and you never pay yourself super from age 32 to 65. Missing $10,800 a year for 33 years with your balance growing at 5% leaves you roughly $635,000 behind an employee on identical income. And here's the part that stings. Most of that loss is completely silent. You never actually see the missed contributions leave. You just arrive at retirement with a much smaller balance, wondering where it all went. Which is exactly why the small monthly habit we covered earlier changes everything. Let's run the checklist one more time so it really sticks. Move 25 to 30% of every payment into a separate tax account and opt into PAYG installments through MyGov, so tax never lands as a single shock again. Pay yourself 12% super every month. Lodge that notice of intent before your tax return so you actually claim the deduction. And finally, check your caps stay under $30,000 concessional and $120,000 non-concessional. 5 steps, and every one of them you can start on today. If you've made it this far, you now understand something most new sole traders find out the hard way, usually with a $23,000 bill they didn't see coming. The single best thing you can do today is open that separate tax account and move a slice of your very next invoice into it. That's it. That's the whole first step. If you want to go deeper, next up, I'm breaking down exactly which business expenses you can legally claim as a sole trader to shrink that tax bill even further. I'm Sophie. I'll see you there.